Good afternoon. Good evening. Welcome to our webinar today. We'll just give it a few more moments for all participants to enter the room. Good morning, good afternoon, good evening to some of you. Welcome to our webinar today. We are just giving it a few moments. We have over 60 participants we're expecting today, and it is not as instant as you would think so far. Welcome, good afternoon, good evening, good morning to some of you. Welcome to our webinar today. We're giving it a few moments for everyone to enter the room. Here we are, almost 60 participants already online. Welcome to our webinar on profitability analysis, a lean management tool. Today's event is sponsored by Triple Jump Advisory Services and delivered to you by us, Inspiring Development. We are a management services provider and MSME banking consultant. My name is Carmen Geil. I am your moderator for today. Our webinar today will last, as announced, 1 hour and 45 minutes in total. The first 1 hour and about 10 to 15 minutes are presentations. The following 30 minutes are entirely dedicated to your questions. Throughout the whole event, you have the possibility to ask questions in writing, either anonymously or showing your name by using the Q&A button in the bottom of your screen. If you were to be on a phone, tap once, you have 3 dots, and then in those 3 dots, you have more options where the Q&A would also show up. Please note your questions throughout the presentation as they arise. We will make sure we answer all of them at the end of it. We're also recording today's webinar for you. And the recording, together with the PowerPoint presentation that we are using, will be available to you, made available to download via email within the next 48 hours. So you will receive an email with the download link for the video and the presentation. Upon leaving the webinar, this is an important request from us. You will see a pop-up window directing you to a short survey. This survey helps Triple Jump and us to really tailor our services towards what you need and what you are truly interested in. We have usually a good idea what you're interested in, but it's so very helpful if you can let us know what are the topics that are of importance to you right now in this time of COVID-19 recovery and transition to what we have all probably come to call the new normal. Please help us by filling in the short survey. It's a few minutes, it's 3 or 4 minutes maximum. As always, today, we are very curious to know who is here with us today. We hope this is also interesting for you. So I invite you to engage with us through the menti.com website. If you access the page on menti.com and you can enter the code for today's meeting, 7355 4912. The first question will go live. You can access it from any computer, from your laptop, from your mobile phone. There is also an app if you would like to download it. It's menti.com. And the code is as shown on screen, 7355 4912. And have a look at the first question. Which country are you calling from today? Welcome to colleagues from Moldova, from Sri Lanka as well. So please do participate in these. We will have a few more questions by the presenters as well around the topic today using Mentimeter, because it is very interesting for most of us to not only know what is our reality, but also have a bit of a look, what does it look like for other institutions that are clients of Triple Jump? So what is the situation like? So please do join us on menti.com. on the link the number 7355 4912. Your answers are all entirely anonymous. So we have no way of knowing who answers what. So rest assured that this is all anonymous. And here we have, welcome to all our participants. I can see it here on my other screen, from India, from Kyrgyzstan, from Sri Lanka, Montenegro, Moldova, Philippines, and Albania. Welcome to all of you. We are delighted that you're joining us today. And here, have we got someone else joining? Yes, just join us if you can. Go to menti.com and use the code that you will always see at the top of the screen in this share. And because we know practice makes masters, we have a second question for you. That is also of interest, we imagine, to you as much as of us. What is your institution? What institution do you represent today? A microfinance institution? A deposit-taking microfinance institution? A full-fledged bank? Or another type of institution, such as an international investor? This, of course, gives us all a bit of an idea who is here with us today. If you're looking for the page, it's menti.com. And here we have already a bit of a picture. Thank you for your answers, those of you participating. There is a majority of microfinance institutions, a few deposit-taking microfinance institutions, about a quarter of banks, and a few participants from other kinds of institutions. So thank you very much. Please keep the page open. The way you accessed Menti, please keep it open. We will come back with a few more questions throughout the presentation to gauge a little bit, what is the stage like amongst the institutions who are here? You remember, all of you are Triple Jump clients, so that's a very interesting environment to look at for you. So, we have a few more participants. You see, a good 2/3 is microfinance institutions, about 1/3 of banks and others. So that's our combination for today. So what else do we need? Of course, I'm pretty sure you want to know who will be presenting for us today. And I'm delighted to introduce you to two of my lovely colleagues. Martina Peter, senior banker with Inspiring Development, has considerable experience in group finance functions and CFO roles in MSME banks. Profitability has been a major topic for Martina when she was CFO, especially of an MSME bank in a particularly challenging environment. This particularly challenging time lasted for 5 years, so she had ample time to analyze, look, and then take decisions going forward and try what things would be like. Marco Mura, also a senior banker with Inspiring Development, is a finance professional with experience across microfinance institutions and bank management. He was an investment officer for a major investment firm and an IFRS consultant. When the MSME he was serving in Africa reoriented their business strategy from the micro to MSME, profitability analysis came to play a major role in that decision-taking process as well. So that's his experience around profitability analysis. So, time we started. So please don't forget to ask your questions using the Q&A function. And then I would like to invite Martina, who will start with the presentation today, to come on stage, and I leave you in her very capable hands. And here comes Martina. Wonderful.
Hello, good morning, good afternoon from my side as well. Welcome to our webinar today. As Carmen already mentioned, we are in a transition phase towards the new normal. Some of us may be already closer to it than others. But in any case, these are challenging times for us because the pandemic is still affecting our everyday lives and work, and it is definitely also causing difficulties for MSMEs in many countries. And of course, this means challenging times for the financial institutions that finance these companies. We see among our clients that financial institutions in many countries are feeling the impact on loan portfolio quality and a resulting pressure on their profitability. And we also know that in many cases, this pressure is expected to increase further during this year. So more than ever, we need to make sure that we not only understand our overall financial results for the institution, but to really understand where our profits or losses are generated within the institution, and based on this knowledge, to make sure that we take decisions to work with an optimized branch network, to have an adequate product portfolio and the right pricing. And it is interesting that despite the vital importance of profitability analysis, many MFIs and banks, even some larger banks, don't have a clear view on their own profitability. Therefore, today in the webinar, we want to take a look at profitability analysis as a lean management tool. And we decided to not stay at the level of the overall institution, but to look at tools that allow us to go a step deeper. to understand where profits are generated and how. So the first tool we want to look at today is branch profitability, something that most of you are probably familiar with. It's a tool that allows to create a complete and hopefully also a meaningful income statement per branch that allows us to gain insights about where the profits are generated in our institution. It helps to identify the potential for optimizing the branch network, of course, but can also just serve as a monitoring tool. Today, we will put a special emphasis on not only looking at the calculation, but how we interpret the results that we obtain from this tool and how we can use it. The next tool that we will take a look at today is product profitability. The approach technically is quite similar to branch profitability. It's just a little bit more complex. And this tool serves obviously to determine whether a product covers the costs that are associated to it. Again, we will take a look at the interpretation of the results. And then the last step for today will be loan pricing, a bit more advanced analysis tool, rather for larger, more complex institutions. But it's very useful to determine, for example, the pricing for new products has more of a forward-looking component. Again, here we will share some important considerations to have in mind when using this tool. And with that, I hand over to my colleague Marco, who will give us some insights on profitability of financial institutions.
Hello, good morning, good afternoon, also from my side. Welcome to the webinar. Before we wanted to get into some of the technical aspects of the tools and analysis tools that Martina was just mentioning, we wanted to discuss some general aspects of profitability and some determinants of profitability. So to look at profitability from different lenses, there are certain aspects that influence profitability or profitability expectations. One clearly is social mission and social performance. So for many of us, and this is, I think, really particular to the microfinance industry, we're not only driven by pure financial profitability, but we also have certain expectations with regards to our mission, with regards to social performance, whether it's the outreach to clients, the involvement of female clients, rural population, and the like, that plays an equal or very important part of our consideration, and that indeed influences profitability. We also have profitability differ in accordance with the organizational structure. Microfinance industry covers many different types of organizations, whether it's cooperatives or NGOs or for-profit commercial banks. So there's many different types of organizations. There are also different regulatory frameworks under which we operate. We've just seen in the Menti-Pol, there are some MFIs or a large share of microfinance institutions, and also banks. And banks typically work under different regulatory regimes. So the type of transactions that are allowed, that are permissible, whether you're deposit taking or not deposit taking, all of that will also influence your expectation and your ability to generate profits. And lastly, the business model or the strategy influences your profitability, whether you only have a very classical microfinance business model of lending to micro businesses, or whether you also have SME portfolio or even other areas like consumer lending. Also these different types of business model will lead to different levels of profitability. Thirdly, ownership structures. Also, this has an influence on profitability, whether it's a cooperative, whether it's locally owned by local shareholders, or whether it's international owners. So foreign entities, also the differentiation between more commercially oriented shareholders and maybe development banks that also carry a certain social mission, will lead to different expectations towards your institution with regards to profitability. Now, before we start sharing a bit of data from the industry, we wanted to see your profitability and the expectations within your institution. So please go back to the Mentipol website that you went on before with Carmen, and we have a few more questions for you with regards to your profitability. What is the level of profitabilities your owners usually expect? And this should not be a short-term expectation of 2020 or 2021, but rather the medium and long-term expectations that shareholders maybe formulate in shareholder meetings, in board meetings. We wait a little bit longer for you guys to type in, but I think the picture becomes already relatively clear. At least 5 to 15%, and quite a large share actually with profitability expectations of more than 15%. Now, we don't know your shareholders, but we assume that some of them are also international shareholders, large development banks or funds that are shareholders in your institution, or you may be part of a larger group. Good. I think the picture is really indeed clear. So 0 to 5% does not seem to be sufficient for any of your institutions, and the picture is abundantly clear that quite a high level of profitability is expected. Now, let's go to the second question. That was the expectation, but what is the return on equity your institution actually reached in the past? Again, not for the past year, again, rather for the medium, long term, maybe the last 5 years, the last 10 years. What is a reasonable level of profitability that you believe you can achieve on average? Interesting. It still shows that most of your institutions are actually very comfortably profitable, with only a few institutions making losses. But I think it still becomes clear if we compare the actual profitability of your institutions with that, what shareholders expect, that shareholders still expect a slightly higher share. I think we've seen a larger share of above 15% in the previous slide, with the expectation that we see now in the profitability that's actually reached, but it's pretty much comparable. So you seem to meet your shareholder expectations by and large, if not fully, but at least close. Then let's go to the last question. What is the return on equity you realistically expect to reach in 2021? Okay, well, we see obviously a little bit of a subdued, a lower profitability compared to your medium long term. There's not as many of you with more than 15%. And we assume that this is due to the COVID crisis, even if the worst might be over in most of the countries. But as Martina said, the new normal, the business environment certainly did not fully recover. The loan demand is probably not up to pre-crisis level, and that will indeed most likely have an impact on the 2021 profitability of your organizations. Good. Thank you very much for this insight. It helps us a little bit to understand both your actual profitability, but also what is expected from your shareholders. And as I said, it seems that by and large you meet shareholder expectations, but shareholder expectations still seem to be slightly higher than the actual profitability that you achieve. We wanted to share with you a bit of data from mixed markets. What you see on the slide here is data from mixed market for the last 15 years, 2004 to 2018, to compare basically your return on equity from the Menti poll with large industry data. And mixed market is the largest data depository for our industry. It collects data from microfinance institutions, but also banks that operate in the MSME space. And I assume that many of you already report to mixed market. Now, what we can see here for a 15-year period, this is a weighted average return on equity over this period. And you basically see that for 80% of the time, the return on equity is somewhere between 2% and 7%. And then you have a few outliers. You have a few outliers with a return on equity of 14–15%. And at the beginning of the time series, a period where it's loss-making. The key message is probably that, yes, a central promise of our industry to deliver profits, to deliver sustainable profits, seems to have been achieved. The mixed market data also shows that around 70 to 80% of microfinance institutions report profits on an increasing trend. So this sustainability aspect, microfinance institutions being able to carry themselves, have sustainable profits, seems to be achieved. But a profitability of largely between 2 and 7%, we've seen in your poll that your profitability levels are a little bit higher, is certainly not the highest levels of profitability. So they might be rather considered modest. We wanted to compare that with profitability data from 3 continents. We've selected 3 countries, Ecuador, Rwanda, and Georgia. Data from the banking industry. This is data from the respective central bank websites, and then we compare that with return expectations of international investors for these countries, and these return expectations that have been calculated with capital asset pricing model and basically capturing sort of the country risk of these 3 countries. What you can see. The banking industry typically is slightly more profitable, so not 2 to 7%, but rather somewhere above 10%. But the international investors, purely commercial investors, I have to say, would expect profits that are even larger to compensate for the currency risk, to compensate for the country risk. Good. That was a bit of setting the scene of understanding a bit the overall profitability of our industry. We wanted to look at some common perspectives on profitability, which we are sure you apply in some shape or form already in your institutions. Financial ratios is probably the most common approach of trying to understand and analyze profitability. That can be ratios on profitability itself, return on equity, return on assets. It can be on particular segments or line items in your income statement, portfolio yield, net interest income. It can be on loan portfolio quality, par ratios, or allowance expense over net interest income, or on expense line items, or overall productivity and efficiency, like cost income ratio or productivity ratios in the lending and deposit taking areas. We all probably do time series analysis, so to analyze the institution over time, to compare the historical performance, to try to understand trends in the performance of an institution, to do that maybe not only for the entity overall, but to do this also on a branch level, on a product level, on segment level. Then we probably all in some form do comparisons to projections, to budgeted figures, actual versus planned comparison in more detail, in less detail, to understand where we deviate, to make analysis on these deviations, and try to understand where profitability or where certain overachievements or underachievements were identified. And last but not least, additional analysis that we do on income and expense line items, of more analytical work that we do on income components, to have a more detailed analysis of the interest margin, to have a more detailed analysis on certain expense line items, to analyze variable costs in greater detail, to further analyze personal costs between salaries and bonuses and the likes. So these, we believe, are typical ways to look at profitability that we by and large see across the industry, even for smaller, less complex organizations. But as institutions grow, and as we've seen, in order to bridge the gap between the relatively modest profitability of our sector and to increase profitability more towards the banking sector, or what international investors are expecting, additional and further analytical tools are required. And we hope that we present today three analytical tools that might help making this next step in analyzing your profitability. Good. With that said, I would hand over again to Martina.
Yes, as Marco said, let's take a look at the next step, at going a level deeper and seeing where in our institution profits are actually generated. For that, we can typically look, of course, at our branches. So which of these branches are profit making, which of them are loss making, and how much of profit or how much of loss is generated in each of them. Something that we cannot see from the overall financial statements, no matter how much we analyze them, but with a branch profitability analysis, we will be able to see that. Another very interesting level of detail to look at, of course, is the products. Which of our products are actually contributing to the profit of the institution, and to what extent are they contributing? Because, of course, both in terms of branches and of products, we're aware that not every unit will be profit making, and this is also not the expectation, but we want to analyze and to understand where the profits are actually generated. So, for example, I might generate most of my profits with microloans, whereas SME loans in local currency, SME loans in foreign currency might contribute less. My housing loans, how much do they contribute? Such kind of analysis is interesting to make. And we added here another level, that is the segments. It's something that is rather typical for larger and more complex institutions, where we would look not only at the product, but rather at a group of clients that uses certain products. So instead of looking at microloans, for example, we would look at micro clients in general with all the products that they actually use. It's a kind of analysis that is a little bit more complex, but also very, very interesting, because it goes just a level beyond looking at products. So here, typical segments, as I've just mentioned, could be the micro clients, could be SME clients, my private individuals, from which I maybe mostly collect deposits, but is this segment actually contributing to profit of my institution? Or here, as another example, we have the treasury unit, which is also can in some institutions be analyzed as a segment. So at this stage, we have another Menti poll for you. We would be very interested in knowing how have you applied branch profitability analysis in your institution? We assume and we know from our clients it's relatively common, but we would like to know among you who are present today how many of you have already made use of branch profitability analysis. Yes, this looks like a very clear picture. Most of you are doing it on a regular basis. And among those who don't do it, the majority is very interested in implementing it. Okay, this is very good. It means we have probably some interesting things for you today. Let's look at one more question. What is the purpose of the branch profitability that you do or that you would like to do? So most of you are doing it regularly. Do you do it only within, you calculate on head office level and you keep the information there, you just use it for your business strategy? Or do you pass the information on to your branch managers? And if so, is it just for information or is it really used to measure the performance of the branch managers? Let's just wait a few more seconds to allow everyone to answer. But we can already see that a clear majority uses the information to give it to the branches. And in many cases, it seems to be used to measure the performance. Very interesting. So it's, okay. Very good to know. Thank you very much. So now that we talked already about branch profitability analysis, let's take a look at how we would approach this topic. As we just saw in the poll, there are both possibilities. It can be done as a one-time calculation, maybe because there are no resources to do it on a continuous basis, or maybe because there is just an ad hoc need to make some decisions about the branch network and it is calculated for that. But actually what we see among the participants and also we see in general among our clients is that very often it is used as a tool that serves on a continuous basis, updated every month, every quarter, and to provide additional insights for the head office, but also for the branches, and to provide this kind of transparency and comparability among the branches. So what do we do if we want to calculate branch profitability? Let's look at the first step. And the first step here is actually, we would recommend to take a step back and look at our data quality. Before we start any calculations, we need to be sure that the data that we base our whole building of calculations on is solid. And this data is coming from the accounting department. So we would definitely always recommend to involve the accounting department to make them aware how the information is used and to really understand how they book certain items, what is booked on the branch level already and what is not distributed there. And for those things that are booked on the branch level, how are they booked? How are they distributed? This first step we think should never be left out. So once data quality is assured, then let's see what are the main calculations to be done. And here we identified basically several layers of calculation. At the basis, we see the basic branch income statement. So to have that, we would basically just allocate all the direct income and expenses of the branch to that unit. Something that for most items is already done in the systems that we have or is done by the accounting team, but sometimes additional calculations are needed, and we will look at those just in a moment. But with just this base layer, there's already quite some information that I can gain from, some interesting conclusions to be drawn. As a next layer, we see the calculation of the funding expenses. And this depends a bit if the institution is non-deposit taking. This is already something rather nice to have, not absolutely crucial to draw conclusions. But for deposit taking institutions, for banks, this step we think cannot be left out. And the step involves determining how much funding every entity needs and to set the right interest rate. And that we will also just look at in a moment. And then we have one top layer here, and that would actually be the distribution or allocation of the overhead expenses, which means that I take basically all the remaining P&L items of my entity and distribute them to the branch level, leaving the head office basically empty. So my calculation pretends that the branches are completely on their own and there is no head office. And this last step is complementary, because if you leave it out, you can still reach your contribution, know what is the contribution margin of your branch. And even if you calculate or if you allocate your head office expenses, we would always look at both levels. What is the profit of the branch before the allocation of overhead expenses, and how much is it afterwards? Because both perspectives are relevant but give different messages. So we've identified here two major topics. One is allocating incomes and expenses, and the other topic is the funding expenses. So let's take a closer look at those two. First of all, the allocation of direct and indirect costs. And here we left out the topic of income because usually this is directly addressed in the system and there is not much manual calculation to do. So let's look at the costs where in some cases there is more to do. First of all, we have the direct costs that, as we just mentioned, very often are directly allocated within the accounting team. So there should not be much to do because the direct costs are linked to the organizational unit directly. And these could be, for example, the salaries of the staff that is working in a particular branch, or it could be the rent expenses for the premises of that branch. It could be the utility bill of that particular branch. All these would be direct costs, and ideally they are directly allocated within the accounting system. Now we have the indirect costs, where we do need to make some kind of allocation, some kind of calculation. And here we have three different approaches. The first one would be the volume-based for the expenses where this is possible. For example, it could be that the marketing department at head office level ordered marketing leaflets, made them print and delivered them to the branches. Branch A got 500 leaflets, each of them cost $1. So I would charge branch A $500 for those marketing leaflets. So this would be a typical volume-based allocation. Still rather straightforward. The next level would be a blended rate where it's not so easy anymore to make a connection. For example, we might have a marketing campaign, maybe a radio campaign that cost $100,000. It's booked on head office, but we want to assign it to the branches. How would we do that? We need some kind of allocation key. We need to define how much is really a fair amount to be borne by the branch. And here we can choose among a variety of keys. Some of them are more meaningful than others. And this is really the crucial point to identify for each major expense item, what is a key that really drives that kind of expense. For example, in this marketing expenses, we could say we go according to the number of clients per branch. We could say branch A maybe has 12% of all the clients in the institution, so we would let branch A assume 12% of the cost of the marketing campaign. Other drivers that are very often used is the number of staff in a branch, is the loan portfolio volume, could be also the net income generated in the branch, could be number of certain transactions, could sometimes even be the number of square meters of the premises of the branch. Really depends on the nature of the item that I'm trying to allocate. And then we have a last type of indirect costs where even this kind of allocation is not possible anymore because there is really no driver. For example, we might have external audit expenses for the bank, and there is absolutely no connection to the business of the branch. So here it is really basically management discretion to decide how much of that should be allocated to every branch. But in any case, I think what comes across here is that this kind of calculation, this kind of cost allocation is always biased. There is no absolutely objective and totally fair way of distributing them. And sometimes we know also that it's a bit tempting to go very much into the details, to be very accurate, which then makes the whole process a bit complicated. Although in general, branch profitability is not complicated at all. Let's look at the other big topic that we have identified, and that is funding costs. As we mentioned, definitely needed if an institution is deposit taking. And let's look at a very simplified example. Here we have two different branches, and as we can already see, branch A has a relatively large loan portfolio, but not so much deposits, whereas branch B seems to be much better at getting deposits. And of course, if we just take our profitability as it comes out of the system, a branch like branch B would probably end up making losses because they pay for a lot of funding, which they actually can't use to invest into any profit generating assets. So we need to find a mechanism to account for that and to kind of reward branch B for collecting those deposits and charge branch A for getting deposits from somewhere else. And to do that, we would first of all fill up the asset side of branch A. We would see, apart from the loan portfolio, what other main items do they have on their asset side? That could be a little bit of other assets, some fixed assets, but probably no significant amounts. But mainly what we have there is the liquidity. And we can calculate how much liquidity a branch would have if it were completely on its own, based on the deposit amount that it has. Because usually the amount of deposits is, of course, the main determinant of liquidity needs. Having that, we could also look at the liability side, and we could determine, based on the asset size and on certain risk weights of assets, maybe how much equity does that branch need to have for its operations if it was a standalone unit. And with that, we can already see that we have a remaining gap on the liability side, which we will address in a moment. Looking or doing the same calculation at branch B, filling up the asset side, calculating the equity amount, it becomes already very clear the liability side is too long. This balance is not balanced. So there is a part of deposits that should actually be taken out to make things balance. And here we would, with our calculation, we transfer the excess deposits to kind of a virtual funding pool. And from that funding pool, we give it to branch A, which has a funding gap. So this is the theoretical background of the calculation. And the main interesting point here is, of course, now, what price will I set for this to happen? And this price, ideally, if I work in a multi-currency environment, should account also for the different currencies that are needed for the portfolio that branch A needs to finance. And if my interest rates are very different according to the different maturity buckets, then I should also take that into account. So setting this interest rate is the key point and can be complicated. But this is really where it's worthwhile to invest some time and maybe also to use some more complex tools if you are a bigger institution. Actually, Marco, you have been working on FTP models in various institutions. Could you add a few words from your experience about this funds transfer pricing, how to set the interest rate?
Yes, thank you, Martina. I indeed worked with several African banks to set up branch profitability and discuss also the aspect of fund transfer pricing, which indeed is one of the more critical aspects of branch profitability. There are a few observations, a few lessons that I think are important to share. The first may be that when you implement a tool like this, that it's critical to make sure that there's a common understanding of branch profitability and fund transfer pricing overall. This is particularly because branch managers, although they have a solid understanding of banking, they often lack a strong financial understanding in the sense of understanding a profit and loss statement. They're just not finance people like most of us. And they have sometimes also difficulties understanding the concept of fund transfer pricing, because it is a rather theoretical concept, and also the interest rate, because they do not necessarily understand cost of funds. They don't understand what are rates in the interbank market. They know very well the interest rates on their loan portfolio, on their deposits, but not necessarily on funding costs and interbank rates. So that's, I think, the first lesson: make sure that people really understand what you're doing, what is calculated, what are the assumptions, to really also take the time to explain this. And the second aspect, in particular on this FTP, is the role of management in this. What I've seen is that for many managers, CEOs that do not necessarily have a strong finance background, they think of branch profitability as a pure financial controlling tool. So they think, okay, some finance people are putting numbers together and see this as a pure financial exercise. But in our view, this is not a financial controlling tool only. This is in particular a management tool. And the fund transfer pricing, the way that you set the rates, is a possibility for management to set incentives across the institutions to steer the profitability. So, for example, if you as an institution, as a management, want to incentivize deposit raising activities, then you do have an interest in setting this interest rate slightly higher, thereby encouraging deposit raising, because the price that branch B in this example would charge or would receive as an interest income would increase. So that is the possibility to model the FTP price, not necessarily only on the market, but make your own touches to it, and to make sure that that it is in line with the incentives and the strategy of the institution. So, and lastly, maybe that branch managers, the institution considers the model as a fair and equitable basis, and that they understand the model, they understand the outcome, they also understand on what basis they are assessed, whether it's the branch profitability or whether it's other targets in terms of volume of disbursements and deposits. Good. Martina?
Thanks, Marco. Very interesting indeed. So, yeah, we've touched the main topics that affect the calculation in terms of branch profitability. So let's summarize a bit. What are the considerations that we should have in mind when using or implementing this tool? First of all, although we had to stay a bit on the surface, of course, here in this webinar, but I think it has come across that the cost allocation and how to set the price of the funds transfer are critical in making certain branches profitable or not. So there is an enormous influence of this, and it's simply something to keep in mind when we interpret the results. The other thing is that we should be aware of strategic considerations when we look at the results of our calculation. As we already mentioned a bit, it is normal for some branches to be loss-making. It is actually very rare that every single branch will be profit-making at all times. And depending on our strategy, actually, it might be perfectly acceptable to have that, because certain branches are in a location that is maybe not profit-making, but is strategic for us. Or we want to show some presence where other competitors are as well. Or we just see some future potential in that branch, which is not yet making it profitable at the moment. And the other thing, and this is really critical in our experience, when we have the results of branch profitability, we should make sure that we organize the distribution of this information and that we communicate well what we want to achieve with it. So we would definitely, when you roll out such a project, involve the branch managers and have some kind of workshop for them where they learn to interpret the financials and they understand what kind of calculation has been made. And we would always also recommend to communicate to the branches what are actually the expectations of head office around profitability, so that they don't start panicking that in the worst case, I'm loss making and they will close my branch immediately. Sometimes these rumors might build up. So this kind of impression should really be avoided. On the other hand, of course, if it's well done and well communicated, there are some huge benefits of doing the branch profitability. And this is also why most of you are doing it or want to implement it. First of all, it gives us really, really valuable insights that we couldn't have otherwise. And it helps to benchmark our branches against each other. And in case we need to make decisions about the branch network, of course, the profitability might be one of the aspects that we take into consideration, but should always be only one of them. And in the best case, if we share this information with the branches, it could also help to create some kind of ownership feeling of a branch manager for the overall result of his branch, and to create also certain kind of cost awareness at the branch that we wouldn't have otherwise. So overall, we find, and we see with our clients also, that it's a very useful tool, but that it should be handled with care. And with that one, we would already pass on to the second tool, which, as we mentioned, uses the same principles of calculation as branch profitability. So again, it is about allocating certain costs. And this tool, different from branch profitability, is actually usually used just as a one-time calculation to get this insight on what products are profit-making, but not necessarily to track this every month. And the main reason being that simply it's a complex thing to calculate. You wouldn't usually have the resources to do this very, very frequently. The approach that we would take, and here we would look at an example of an SME loan. These are figures from a client of ours, is that first of all, we would look at the income that a certain product generates. So here, when we say SME loan, really this is like the average loan that is part of the entire SME portfolio of that client. And we would just allocate the income consisting of the nominal interest and of the disbursement fees that correspond to these SME loans. Here, in this example, this would be 14.6% of effective interest rate, basically. Then in the next step, we would allocate the direct costs to that particular product. First of all, starting with the cost of funds, where we come across exactly the same topics as we just mentioned, as Marco also just explained. We have to find out how much is the amount that needs to be financed, but mostly also we have to find out what is the right interest rate. Again, keeping in mind the currency and the maturity. That would help us to get to the net interest margin. So in this case here, we have 8.6%. As a next step among the direct costs would be, of course, the cost of risk of SME loans, which is not a major thing. It's either in the system or it can be calculated based on the regulatory requirements. Maybe the main driver here would be the number of days in arrears. So we would take the average days in arrears of our existing SME portfolio. Or for those that use IFRS 9, we could apply some kind of average PD and average LGD to derive the cost of risk, which here would be 2.1%. And then the last step here in the direct costs would be the direct personnel expenses. So this is the expense for those people who are directly involved in offering this product. And here we would have to measure or estimate the average time that these employees invest into SME loans. Then comes the more tricky part, the indirect costs. Here we would start with the indirect personnel expenses, and this is now all the staff of the bank, also those who have absolutely nothing to do with SME loans. Might be people in the marketing department, legal, the head office credit risk department, so everyone basically. And we have to find out for everyone how much time they dedicate to that particular product in order to derive the expense that should be allocated to SME loans. We do the same for the operating expenses, for the other operating expenses. And here again, we would need allocation keys. So again, there's a lot of room for using different keys, which would change the results. And with that, we would arrive at a pre-tax net profit of 2.3%. So if we look at those numbers, we can see that in this particular case of this institution, there's quite a heavy load of head office expenses, both in terms of personnel and operating expenses that is charged to this product. But still, it's a profit-making product. We deduct the tax expenses because, of course, there is a corporate tax rate to be applied. And we would see that the net loan income is 1.9%. So it's a profitable product. But there is one additional thing that we should keep in mind, and that is the cost of equity. Because to offer SME loans, we need to have equity, and equity has an implicit cost. And the implicit cost is, of course, the expectation of our shareholders of what should be the return on this equity. So keeping that in mind, calculating the amount of equity and applying this expected return, which here is 4%, we would actually see that the product is not contributing to profit anymore. Now, what can be the conclusions drawn from that? So in the case of that client, it was, of course, not to stop offering SME loans. It was rather to grow that portfolio, to proportionally decrease this burden of head office expenses that has to be borne by the product, because they did see a lot of potential in the product to be offered. So this was just a very simplified example of product profitability analysis, but I think what comes across is that it's the same principles that are applied, but just the allocation is more tricky. There's more detailed work to do with the allocation of expenses. So what would we recommend when you use it? Pay attention and be aware of the influence of the cost allocation here. And again, keep in mind the strategic considerations. It is normal to have certain cash cows in your product portfolio. And it is normal also to have products that are hardly contributing to profit or not contributing, because simply they help to attract certain clients with whom you want to make business with other products that are indeed generating profit, for example. So just to keep that in mind, to get a balanced picture out of the results. And again, here, of course, there is a big upside of using this because it really reveals where we generate our profit and whether we also depend completely with our profit on just one or two star products, cash cows, and everything else might be loss-making, for example. So these kinds of things we can see by using product profitability. And ultimately, also it can help, of course, with our pricing decisions in the long run. And there's much more to loan pricing, actually. So I will hand over now to Marco, who will give us some information on loan pricing.
Yes, indeed. The last part of our presentation is on loan pricing, which is a bit familiar and sounds similar to product profitability. But we'll see that there are indeed small differences between the two approaches. Before we go into the calculation, the technical aspect of it, there are typically three types of approaches that we see in loan pricing. One is a pure price taker approach, which we believe is probably the majority of the institutions. So they simply observe the market in which they're operating, look at the prices of competitors with similar products, and then might differentiate their pricing on the basis of competitive advantages or disadvantages. So maybe your institution is lending faster than your competitors. Maybe you have better terms and conditions for your clients. Maybe there's a different pricing structure. Maybe your marketing, your positioning in the market is different, and this you would then this information you would then take to basically modify the market that you see from your competitors. But in essence, it's a price taker approach. You basically assume that there's a market price, and you cannot go much above or below it. The second approach is the more analytical approach, the cost plus approach, which is then indeed very similar to what we've seen in the product profitability. So it's basically a detailed pricing approach that tries to analyze the different components of cost that are associated with a disbursement of a loan. The components are obviously similar to what we've seen already. So you have certain funding costs, you have risk costs, you have operating costs that need to be earned, and cost plus. The plus means that there needs to be a profit margin, and we'll discuss this in a minute, how this could be determined as well. Last but not least, and this is more of a commercial banking approach, a market value approach, which is applied in more developed markets, where a market value is basically derived from money market, interbank market, capital markets, where you just try to basically calculate an interest rate on a specific rating of an institution. So this is certainly more for commercial banking, for larger loan sizes, and not applied for the typical microfinance industry. On the loan pricing components, as we said, there are the typical components that we see in product profitability. Funding cost is clearly one aspect. Martina already mentioned that funding expenses or funding costs can be modeled in different granularity, in different complexity, considering currencies, considering maturities. I think that is a critical aspect, because to refinance an SME loan or a 2-3 year loan is certainly more expensive than to refinance a short-term micro loan. So considering the tenor is critical. The second part is the risk costs. What we see here is typically to operate with what we call standard ECLs, so standard expected credit losses. We all calculate these ECLs or loan loss provisions for the purpose of IFRS 9 or similar accounting frameworks. But to calculate risk costs for a specific loan just simply means that you have to be in more detail. So if you want to go this route of loan pricing, it is a clear incentive to professionalize your IFRS 9 methodology. So to analyze ECLs not only for the entire portfolio or not only for different product groups, what we typically see, but to also analyze ECLs, for example, on different industry, for example, on different maturities, for example, for different regions. So to just add additional dimensions. And It is also clearly an incentive to professionalize your underwriting, so that also your pricing overall is basically determined on a more elaborate risk analysis. And so we've seen in the industry over the last few years, scoring methodologies gaining in importance, which is exactly this idea of basically adding multiple data points to determine the expected credit loss. So that's clearly a way that helps to achieve a more detailed and accurate loan pricing approach. Always bear in mind these risk costs, their lifetime expected credit losses, but you need to annualize these costs. So you need to turn sort of a percentage of loan loss provision or an expected credit loss in a nominal amount into an annualized percent. So that's just one twist, one mathematical twist that you need to be aware of. Then you have the operating expenses. We discussed already the general approaches. There's a full cost approach, there's a partial cost approach. So you take only the directly attributable costs, so also the overhead expenses. Typically for short-term decision making, you would take the directly attributable costs, because the overhead costs would indeed proportionally shrink the larger you grow your loan portfolio. The best approach in dealing with operating costs for loan pricing, this is also the standard in commercial banking, is to go the route via what is called activity-based costing or process-based costing, where you basically analyze those processes that are associated with the lending cycle. So searching for the client, the analysis, the disbursement, the monitoring, etc., and then to basically add an overhead charge to this. Last but not least, on operating expenses, shall we deal with actual cost or planned cost? And this is maybe one of the key differences between product and loan pricing. The perspective here is a forward-looking perspective. So you're trying to understand what is the price you need to set today in order for this loan product or for this loan to be profitable in the future. So in effect, it means you basically have to deal with planned costs and not with actual cost. So it just means that you have to take into account certain developments, certain trends. If you see that inflation, for example, is going up, then this needs to be reflected in your loan pricing. And last component, the plus in cost plus, the profit margin. As Martina was saying, the product at the end of the day also needs to earn, excuse me, needs to earn a profit. And this profit, from our perspective, depends a bit on the risk of the product itself. So any product that exhibits a higher volatility should earn a higher profit margin. And any product that is a rather stable product should be fine to have a relatively low profit margin. Let's take a simple example. Agricultural lending, in our experience, is typically a more risky type of product because it can be seasonal, it can have good years and bad years. So for a product like this, I would typically charge a higher profit margin than, for example, for salary loans, which typically is a more standard approach, and that and less risky product that would allow for possibly a smaller profit margin. Good. There are in loan pricing approaches, as we said, the difference between product profitability and loan pricing. They are similar indeed, but there are certain differences that are critical. First, I've already mentioned Product profitability is typically a backward-looking exercise. You just take historical data and see over a certain period which product contributed to a given profit. But it's really just a historical analysis, whereas loan pricing has the expectation to be forward-looking and to capture these costs on a forward-looking basis. The granularity is obviously different. So to look at it from a product perspective or individual loan, which means the product definition is usually broader, and the loan pricing is a lot more granular, which means all the different components needs to be analyzed differently, as we were mentioning. So the risk cost and the operating costs, you can't just take the same assumptions that you have from your product profitability, which is a weighted average calculation across all industries, across all currencies, across all maturities, and apply this to loan pricing. You have to be more granular in the analysis. Good. That brings us to some of the considerations that we wanted to share, and certain aspects that I think are critical to look out for when discussing loan pricing. One is the organizational setup. Traditionally, loan pricing is a function of the asset liability management, so it's typically done in ALCO committees. Some institutions have taken these loan pricing decisions out of ALCO and set up a separate pricing committees. So whatever the setup is, from our perspective, it's just critical that there is a balance between what we call markets and risk functions. So between business people that typically want to drive prices down because it makes it easier for them to disperse loans, and between people like risk managers or financial controllers that are more interested that the products actually earn the expected profits. So there needs to be a balanced approach, a balanced discussion on this. Frequency of loan pricing or loan pricing analysis, this differs very much of the framework and the environment of a given institution. If you work in a very competitive environment, then loan pricing calculations obviously need to be done a lot more regular than if you're in an uncompetitive environment. It depends on the overall market environment as well. So the economic environment, inflation levels, foreign exchange movements, the developments in the banking industry. Are there frequent banking crises? Are non-performing loan ratios increasing or decreasing relatively quickly within your sector? All of this would determine whether you do these kind of calculations on a monthly basis or rather on a quarterly or yearly basis. Historical versus forward-looking, we already mentioned. It is obviously difficult to do this kind of calculations on a forward-looking basis. We all cannot predict the future. We all don't have a glass ball that would tell us how risk costs are going to look like a year from now. It remains an estimate, but at least our recommendation is to try to understand main trends in your market, main trends when it comes to risk costs. So you need to have the overall performance, the overall risk profile of your banking industry in sight. You need to have a good understanding on different industries, how they develop. We've seen now with the COVID crisis that particular industries can be hit relatively hard. So pricing for tourism should remain probably higher as a loan price as compared to other industries. So understand these main trends also in terms of costs, what we mentioned before. If you understand, or if your expectation is that inflation rates go up this year in your country, then you have to accept or expect that also your operating costs go up by that percent. And then this needs to be reflected in your loan price. Otherwise, you charge a price today that is simply too low to cover the costs of tomorrow. Adequate level. What is an adequate level of loan pricing? What's an adequate level of profitability? We touched upon this a little bit on the profit margin of what can be charged. It remains obviously a key aspect of the final decision of how you set prices. And as I said, many of us are price takers because we operate in more or less competitive markets. But try to understand what is an adequate level in terms of the volatility of these products, in terms of the risk that these products bring into your institution. A consistency of loan pricing. This deals with the consistency between your pricing approach and your client selection. Each institution has a certain strategy to market itself. Maybe you're a mass market institution that tries to get as many clients. Maybe you're a very selected institution that really just wants to select really good clients. So all of this matters. If you're a mass market institution, then your pricing approach might be different than if you're a very selective lender. And also make sure that your pricing is consistent with your whole positioning in your market, your whole marketing strategy. You can be more expensive than other institutions, or you can also be cheaper than other institutions, but it just needs to be consistent with the way that you market yourself to your loan clients. And last but not least, the risk profile. Take this into account when taking these decisions. What you cannot do is what we really argue against is that if you are an institution that you're maybe very good in one product and are very competitive, meaning you are maybe the cheapest for a certain type of loan, for a certain type of product, and more expensive for other types of products, it can lead to shifts in your loan portfolio, that you have an increasing share of one loan product or an exposure to a certain industry, that then shifts basically the entire risk profile. So if you're the cheapest in lending to hotels, then you might be expecting that a lot of your clients in a year from now or 2 years from now are in the tourism and hotel industry, and that simply creates certain risk concentrations that you might want to be aware of. And last but not least, strategic considerations, outreach plays a role. If these targets are existing in your institution's loan pricing considerations, and decisions need to be taken on the basis of these basic strategic outsets and the question of your overall mission. Good. With that, I would hand back to Martina.
So here we are. We've seen the 3 tools. Let's summarize the main learnings from them. We looked at brand profitability, product profitability, and loan pricing, and we consider that this is not only the order in which we presented them, but it's also the order of complexity and the order of relevance for institutions. So we think that really branch profitability is something that is a suitable analysis tool for any institution, even if it's a very small and not complex one. And as you saw in our approach, there are also, you can only do certain steps and already from that gain quite some new insights. Product profitability, we said it can be interesting to analyze with a lower frequency, yeah, loan pricing, as we heard just from Marco, has more of a forward-looking perspective. The benefits, I think they are really obvious. the tools help us to, when we make decisions, to replace gut feeling by solid information, by data that we can produce, so we can make more informed decisions, and we can really also identify whether we have profitability potential in certain products or branches, or whether we have a strong concentration of our profitability just in a few units. The recommendations that we have, once again, is to always ensure the data quality, which is the basis for everything. The results can never be good if the basic data that flew into the calculation was wrong. To be very much aware of the sensitivity of the result to certain screws that you adjust in terms of the price of funding and the allocation of expenses. And especially when it comes to the branch profitability, to handle the topic with care when you communicate inside your organization. And with that, we are ready for the Q&A session. Marco and Carmen will join me for that.
Hello. I see there have been already a couple of questions raised, but please feel welcome to add more questions.
Yes, as many questions as we can possibly answer. I'll turn off the presentation for now. We'll quickly come back to it, but for the questions, we'll just be here as your conversation partners. And I'll just take the first one. Oh, there's one about mixed market. This would be difficult to answer. I don't know, Marco, have you got an opinion on it? It's how does mixed market still collect data? Does anyone still report?
No, it could well be, because when I looked, when we assembled the data, they indeed only showed data until 2018. So it could well be that they basically discontinued. They still have the largest time series, so I would assume, well, 2019 was anyways an odd year out with the COVID crisis, to not maybe have this as a comparison of the overall profitability of the sector, but indeed they seem to have discontinued the collection of data.
Okay, thank you. So we're waiting to see, hopefully they might start again, or what's going on. Then we have a next question on branch profitability, very specific. What is the popular overhead application?
So it's not entirely clear to me what is meant here. So I understand that it's about how we allocate the overhead expenses. So there are as many different ways as there are institutions, and there is no right or wrong way. So the key tool is really to go line item by line item, to identify the major line items of your P&L and identify how they behave or what really triggers them to increase or to decrease, and find a key. For many line items, there is more than one possible key. And sometimes one also has to play around a bit and just experiment. I think this is all I can say to that. And yeah, shall I also just stay with the next one?
Yeah, I was just going to say, let me read it. Yeah, I think you can all then see it, but how to allocate cost of capital. If shareholder expectation is 15%, shall we just apply 15% for each loan product? We were thinking about capital allocation depending on the risk weight of the product and the capital needs for a specific product. For example, for SME, we would allocate less capital. For microloans to individual, we would allocate more capital. It is more risky. Does it make sense?
So yes, for the allocation, if the shareholders expect 15%, indeed, I would use that for my calculation. So I would try to determine the amount of equity that is needed to offer that particular product and take 15% of that. And the question about the risk weighting, here, I think I would very much let myself be guided by the regulation that applies. Or if there is no regulation about it, maybe because it's a largely unregulated MFI, one could maybe take the main ideas of the Basel standard, where actually it is just the other way around, that the SME loans would bear a higher risk sometimes than the micro loans, because there the main idea is the granularity of the portfolio. Microloans are tiny, and the idea in the Basel standard is that tiny portfolio means that if one of those loans gets lost, it doesn't affect the capital so much because we have a large base, and therefore they get a benefit. So one could take that thought or just apply also the same risk weight if maybe they are not too different, the SME loans and the microloans.
Thank you. Something, Marco, to add? I know the Basel standards are your topic. Okay, good.
That sounds pretty comprehensive.
So we're jumping slightly to a different topic, but is it advisable not to factor in indirect costs, i.e. head office costs, to branch profitability analysis?
Yes and no. There is these two schools of thought to have what we call cost contribution or partial cost approach and full cost approach. And in our view, both of them have a certain benefit and have certain advantages and disadvantages. It really depends a bit on the situation. I think we all understand on the long run, overhead cost needs to be earned by the branches because that's where we make the revenue. So this revenue needs to cover your audit costs, your head office costs, and anything else that you would consider overhead costs. But as a decision-making tool, I think it's more critical to understand what is the conclusion. So the best approach for us is to calculate both, to basically calculate a contribution margin that only allocates the direct costs, and then to look in a second step on the overhead costs. If you want to go even one step further, you can allocate the overhead costs. You can split these overhead costs even in two different portions. Similar to what Martina said, there are certain overhead costs that are basically variable costs, so they change with each disbursement of loan. So, for example, credit risk costs. You have certain credit risk people that sit in the head office and they analyze and approve a loan. So their costs obviously dependent on how much of these loans a branch disperses. And then there are really truly overhead costs that are fixed costs in nature, like audit costs, insurance, consulting costs, and so on, that do not change with each and every product. So that's sort of the three-layer approach that we see in advanced calculation. So a contribution margin approach, and then in two second layers, the allocation of head office costs. The conclusions are different, right? So a product definitely needs to earn its contribution margin. This is sort of the minimum. It needs to do that. And it should also cover the other variable costs from head office, but the other fixed costs, they can. It's fine if they can't cover it right now. I think Martina, you mentioned also a similar example. These fixed costs, they become proportionally smaller if your institution is still growing, right? But if you and then it's fine that you still make a loss in a certain branch. However, if you're an institution that's already branched out, that is not expecting to grow anymore because you may be operating in your country already for 50 years, then indeed that becomes a problem. So then, because then these fixed costs will not shrink proportionally anymore. So I hope that covers this question.
Yeah, a lovely yes and no answer here, which is, yeah, the way it is. Both ways make sense at certain points. Thank you for that. So I think this one for Martina, the handle with care on branch profitability.
Yes, indeed.
Can you go back to that?
Yes. Why should it be handled with care? Interesting question, because we just had a discussion with several banks from Asia yesterday where CFOs reported about the problems that they have with branch profitability, or the kind of discussion it triggers with the branch managers over and over again, because they feel treated unfairly and very often start arguing about details. Why do you allocate this? Why do we give me more of that than to my colleague at the other branch? So when it's not implemented right and with the right communication strategy, branch managers might feel under pressure and they might start to fight for not having to bear this or that expense, which obviously distracts the attention from the result, which in itself is helpful and useful. So this feeling of being treated unfairly can be one thing. And when we measure the performance of the branch managers according to the branch profitability, we should also keep in mind that this can create a certain kind of frustration because a branch manager cannot entirely influence the result of his or her branch, because many decisions in the branch, they are given the certain product portfolio that I can offer, certain pricing range that I can use, maybe the number of staff or how much I pay to my staff. So a branch manager is not completely autonomous. It's not managing his own business. And if what we communicate about the results of the branch profitability doesn't properly reflect that, it can create a certain level of frustration. Plus, worst case, of course, in banks that are cutting branches, and where this is known, of course, it can really create a feeling of panic among those branch managers that see a negative result and they feel like this is, I'm going to be the next one, which might not necessarily be the case, but it can really affect the motivation of people. And we've seen cases of that.
Thank you. So thank you for your questions. We have a bit more space, so if you have some more questions, please feel free to add a few more. We've got here, we're going to the next one on the ones. Oh, I actually know. We got one of your questions in the chat as well. And I think Marco, is the EVA and RAROC for you? I think.
The economic value, no.
So the question is, would you recommend EVA or is it RAROC, sorry, as more specific tool for profitability benchmark in case of bigger organizations?
The RAROC is basically the risk adjusted return on capital. I haven't seen concepts like this. So, I mean, it goes in that direction of a bit similar to what we said with the risk-weighted asset approach. I haven't seen such a RAROC approach actually in our industry, if that is the more common approach in banking. But what we've seen until now is really largely to work with either risk-weighted assets and then basically regulatory capital requirements, or if the company has its own capital management policies, to see how they basically consider the riskiness of different types of asset classes.
Yeah, thank you for that one as well. Then we go to our next question. When analyzing different product profitability, how to best split equity costs between them, based on loan portfolio dimensions or on cost of risk of each business line? That might be very different.
I think I can take that one again, because it's a similar direction. So I would indeed take the regulatory concept of how much equity is needed. And the regulatory approach, mostly known from the Basel Accords, but really in any country I've seen, the basic idea is that the equity need is driven by the size of the asset or off-balance product and with a certain risk weight. So if I have a regulation like that, I would always use that. I would take the amount of that product and apply an average risk weight.
Okay, thank you. Then moving on, we have many branches. How can we handle analyzing them properly? We do P&L and ratio analysis, but sometimes with such huge data, it is hard to analyze. Is there a sort of a simple tool, or is there, what can you recommend when there's a large amount of branches? and these large amounts of data?
Well, I think from my perspective, it's like you need to indeed condense information. I think that's clear. We've seen institutions with 200, 300 branches, and then it becomes a graveyard of numbers. So you need to condense it both for analytical purpose, but then more importantly for decision-making purpose, right? So you need to understand what's the data that you want to get out of this. So, which means you need to focus on certain key line items. This goes to the discussion of whether you look at contribution margins or net profit. What we see is that basically that a controlling department basically sets a certain threshold. So it says, okay, we expect a certain profitability or certain contribution margin between whatever 5% and 10%, and then everything below 5% would be automatically flagged in red, so that out of 300 branches, you immediately see those ones that require your attention. And those then that are above 10%, you would see in green lit. So that's maybe one aspect to make sure that you shift your attention on those outliers that really require your attention, depending also to which extent you want to engage with these branches, right? So because if you do these calculations only for the sake of calculation and then for the sake of discussion at head office level, then you can look at as much data as you want, but if you want to engage with the branches, you cannot engage with 300 branches. So then indeed you need to make a rather a small selection, and then you need to highlight this with, as I said, certain ranges, certain expectations that you formulate. What else? I think what we've seen also is that we see branch profitability calculation also used as a cost controlling tool, so that we see, for example, branch costs, direct branch costs are compared to budgeted costs, and then you have a guy sitting in a controlling department and basically comparing this. And again, with a large number of branches, he would not come in and discuss every $50 deviation, but he would basically set a certain threshold and say everything above 10% over budget, 15% over budget, I let it flag up, and that automatically send out an email to the branches so that they explain certain deviations. Otherwise, you will not be able, indeed, to handle 200 or 300 branches.
Thank you for that. That is a particular challenge when we start having really large institutions. So then we have a request for a few more examples of direct cost allocation drivers for product costing. Maybe a few more on top of what we've heard, or in that direction.
Indirect cost allocation.
Mm-hmm.
Okay, there's such a variety I think we've seen in practice. First of all, maybe it really depends on the granularity of your data, because many institutions, they have an accounting system, they don't have a cost accounting system, right? So they don't have cost centers on the head office. So, for example, personnel expenses are the largest individual item in your expenses, most likely. It's going to cover 50 to 60% of your total operating costs. If you are having your staff expenses at head office only in one account, saying staff expenses head office, then you have to use one allocation key, right? Then you use what Martina was saying. You use revenue, you use total assets, you use loan portfolio. It really depends. If you are able to have your staff expenses broken down by departments, then you can obviously determine an allocation key for each department, and then I can pursue the purpose of what I'm doing a little bit more diligently. I think Martina highlighted what's the key. What you try to do is to identify cost drivers. So HR costs, for example, makes probably sense to do this by staff numbers, because your HR department probably has the same amount of work for each employee, right? So and then it makes sense to do it this way. For other head office costs like a credit risk department, it makes more sense to do this per specific loan that is sent to a credit risk function at head office to analyze, assess, and decide upon. And then there are those really indirect costs that are not associated with any output, with any lending or any provision of services. So regulatory costs, risk management costs, accounting costs, for which, in my understanding, you would typically calculate a percentage of indirect costs on the direct costs. So you just you have a direct cost, which is a certain amount, and then you have a certain add-on charge, whatever, plus 5% to cover your indirect costs.
Thank you. Hopefully that was a few examples in addition, and we were hopefully covered what you were looking for. We also invite you, please, if you have a very specific question on a specific cost, maybe you could also send that in if you like for a question, and we'll try to answer. How to allocate cost of risk if there was a bad year due to drought and a big share of loan portfolio was restructured and there was a 1-year spike in cost of risk if analyzing current product profitability?
It's a good question. And in such a case, indeed, I would deviate depending on how you calculate the cost of risk. Of course, if you do it based on your current, for example, portfolio in arrears more than 30 days, this would, of course, would be good to take more of a longer term average and not that particular point in time, because this will not give any meaningful result to just take this one-time spike. If you do an IFRS approach, then anyhow you use the PDs and LGDs, and they are derived over a longer time period, so they should not reflect such a sudden hike in the rates just because of a 1-year event. So there, this effect would already be mitigated.
Okay, thank you. Then I would go to the last one first. If we have big branches and very small ones, what ratio is usually used to distribute the head office expenses, indirect ones, portfolio volume? If you have very big ones and very small ones, is there some particular you can recommend in this situation?
And big and small is in a sense of portfolio volume, right? I think it's really, Martina, I think it's really down to preference. I would always prefer these indirect costs, to be frankly, to put it on revenue. Because look, if I have a large, if I have 10 million portfolio of SME loans, and Martina, as a branch manager in branch B, has 10 million in loans, in micro loans, she will probably earn more revenue, right? So if you use GLP, it doesn't make sense. So it just, well, it makes sense, but there's, I just think it's a fairer allocation to do this on a revenue basis. So this is, but maybe this is also because I come from an accounting and tax perspective, and in transfer pricing, which is also a concept in international taxation. Then where you have similar questions of how you allocate certain overhead costs to subsidiaries, for example, and then revenue is the most commonly applied approach in international organizations, international companies, and accepted by international tax authorities. And so not only because of this, I think it's the best approach to take, because revenue just seems to be a fairer allocation, because it then gives you a certain percentage of your revenue is knocked off with your indirect head office expenses. Martina? But as I said, it's preference, right?
Yeah, I agree. I agree. And maybe I would just point out that if that even without allocating the head office, you can already gain quite some insight. So if you feel insecure about whether the allocation of head office expenses really gives you a meaningful result, no matter what key you use, you think that nothing is really appropriate, you look at one line above that, the contribution margin, which is much more objective.
Righty. And then we go to what is currently our last quick question, and it takes us to a topic that is FTP pricing, methodologies and examples. Could we give you some more on FTP pricing, methodologies and examples? That is indeed, thank you for that question. It comes a lot. It's one of the big questions going around at the moment, and I think I'll leave it to Marco, I guess, to maybe say a few words.
Yeah. I think we hope at least to have covered some of the key questions on this FTP pricing. I think, Martina, you mentioned the currency aspect, you mentioned the maturity aspect, and that really depends institution to institution. If your maturity structure, asset and liability side is relatively identical, relatively short maturities, because you're sort of a classical microfinance institution that has 6 months, 9 months, 12 months loans, then the maturity doesn't matter to that extent. Or if your interest rate curve is relatively flat, then maturity, the structure of FTP pricing is a nice thing to have, but it's just not going to turn your numbers. It's just not going to add a lot of value. So it's just a lot of work for only a little bit of outcome. For larger organizations, and in particular for organizations with longer maturities, they do indeed have a more elaborate system that does indeed capture currencies if they're in a multi-currency setting, and it does indeed capture different maturities. So what they basically do in a nutshell is to calculate an FTP curve, which is basically an interest rate curve that tries to model their funding costs on the basis of a certain maturity. So how much would it cost for them to borrow in the interbank market for 6 months, for 12 months, for 2 years, for 3 years, for 5 years? This would basically generate this FTP curve. And this is then basically the pricing curve with which different maturity buckets are priced. So you would basically calculate what Martina was showing as an excess of liquidity or as a shortage of liquidity, and you would break this shortage of liquidity down alongside your maturity structure. So you choose maybe 0 to 6 months, 6 to 12 months, 12 months to 2 years, 2 years to 5 years, and you break down this funding needs into these different buckets, and then into these different buckets you have an interest rate curve that charges for short-term funds a lower price than for long-term funds. And there's obviously multiple ways of how detailed you can do this. Also depends a lot on your environment, as I said, a bit on yourself, also a bit on whether it is easy for you to compute this FTP curve. But it's also critical that once you have this fund transfer pricing curve, that you also understand what it leads to. Because in many institutions, if you use an interest rate curve that models basically the interbank market, it leads tentatively to deposit branches being disadvantaged, and branches with a lot of excess loan portfolio and a shortage of funds to be more profitable, because the margin, the lending margin, is typically larger than the deposit margin. And then in scenarios like this, and this is what I meant before, branch profitability is a management tool. You need to set this FTP curve to work for your institution, for your strategy, for the incentives that you want to set. Don't make this a pure theoretical approach. Yes, the commercial banking industry uses interbank rates, but if it means that you set your incentives wrong and that it disincentivizes deposit raising, then simply shift the curve upwards to the extent that these deposit raising branches are adequately rewarded.
But I also take from this, it's a very complicated topic.
Yeah, there's just a lot of questions and a lot of subjectivity to this, but I think it's good, but for us it's really critical that don't treat this as a textbook finance exercise. You can read about FTP pricing in very beautiful finance books, but consider the impact, consider your strategy, consider what the conclusions of it are. So I think that's the more critical part than just doing the model 100% state of the art. So it's not a beauty contest, but you need to make sure that you manage and you steer your company with this model.
Thank you for this, Marco. And this was our last question here. So thank you very much. Thank you to our two lovely presenters for all the answers. Thank you for our participants for all the questions, the interesting questions. And thank you also very much to Triple Jump, without whom this would not have been possible today. So thank you all around. We have one last small request from you. We've taken a few more minutes, sorry for that. And we request even a few more minutes for you to just spend some time with the survey that will pop up when you close the webinar, when you leave. It is important for us to know, because these webinars, we set them up in accordance of what you tell us you actually are interested in as topics. So do take a few minutes and let us know how today went. That's the first few questions. And then let us know what else is of interest to you in general from Triple Jump. How can we, inspiring development, how can we serve you better? So, as I mentioned earlier, recording in PowerPoint, do not worry. Within 48 hours, you'll get the link in your email from the Zoom account. And remains for me to wish you a very happy day. Have a wonderful day and stay well. We still live during extraordinary times. Thank you.
Goodbye.
Thank you very much. Bye-bye.